Well, here's why. Because I was really lucky to meet my boss, meet someone who specialized in this, and I learned about it. I was in the mortgage business for 4 years and fell into this, and I'm super grateful because of the value that I can bring to people. But the reality is that most people have never heard of this in the United States. In Australia, this is the main type of home loan that they do.
Mhm.
South Africa, it's really popular. Throughout Europe, it's another kind of home loan that in pockets of Europe they choose when it makes the most sense because they know about it. It's a common sort of everyday option that they know is available. That's just not the case here. We don't know about it. And so now what you've got is some random guy, Anthony Rushing, right, saying, hey, I've got this home loan you've never heard of before, and you can pay off your home in 7 years, and you don't have to change your budget, right? And that is crazy. And we are just bombarded by things that are fake, that are too good to be true.
Mhm.
And so I think that's why I think we've been conditioned with anyone that says they've got a new thing that you've never heard of and it's going to, blow your socks off, right? That you say, I'm putting that in the don't call me bucket, the do not disturb bucket, like don't text me back, do not reply. I'm not going to give it an ounce of my time because most of the time it is fake. Most of the
Yeah.
time it is too good to be true, and you get burned and
Mhm.
and you get hurt. And so I honestly think that's why, because it's a new concept. You've got a small group of people who know it extremely well, but you don't have big banks pushing the idea, right? You
Right.
don't have big institutions doing a lot of, spending millions of dollars in marketing to raise awareness for this. And so uh,
Well, I think that we know why.
I
I think
think we
we
know
know
why.
why.
I think it makes sense, right?
Yeah.
I wonder why, if it's such a great product, why a bank would not want to push it. And if I think about the purpose of banks, it's to make money.
Right.
That's their purpose. And if there's something that can make them more money, they're going to push that.
Yeah.
Um, Reality is that when this works, and I know I keep coming back to the when this works, but when this works for people, um, they can save hundreds of thousands of dollars, which
Yes.
means that's money that stays with them and doesn't go to the bank. And
Right.
so, and so there's no incentive for banks, big banks, to really push this concept because it wouldn't necessarily bring them more profit than amortized mortgages because of the
Right.
way that amortized mortgages are set up and built. And so,
Right.
I think that we've been conditioned to think that amortized mortgage is the only thing that's there.
Mm-hmm.
And
And
so because we believe that anything new that hits, we're like, oh, okay, it's got to be a scam. Just that's the natural reaction that people have.
mm-hmm.
And we've also been convinced to give the banks a lot of money and be proud of it because our rate on our paper is nice looking,
Yeah.
right?
Yes, that's another misconception that, if you've got a 2.5% mortgage, then wow, that's as low as you can go. And,
Right.
if you're in a 7% now and I literally had a client last week had a 7% um, interest rate on a mortgage, and they offered them a 6.5%, and they took it and they refinance after being in that mortgage 1 year. And you're like, oh my goodness.
It's really tough because that is a strategy that mortgage companies have, is that there are certain benchmarks that if you have a higher rate, at which point you call the person back because the
Mhm.
rate's gone. A lot of times it's a 1 point differential. So if you're at a 7% rate, they have triggers that once your interest rate would hit 6% with what's available now, they're going to call you and say, hey, I can help you save some money. Well, what we forget about that is And maybe we forget, maybe we just aren't aware. But I don't know if you've looked at the amortization schedule, but the way it works is at the beginning of the schedule, you give the bank the most amount of your payment, and the amount that goes to you is the smallest. So
Hmm.
as you go through that schedule, you start to give yourself more money and you give the bank less money. Well, once even if you get a lower interest rate, you go back to the beginning and you reset it to give the bank the majority of you go back to the weakest place in that whole schedule. And they know that.
Yeah.
They know it, and they still make tons of money. They make tons of money off of you every time you reset your amortization schedule, and
Yeah.
that is never talked about. That's
Never.
not something that they focus on because that would kill the whole game
Right.
of them getting the most money because what they know is that you're not going to hold on to the loan for 30 years, most likely.
Oh, yeah.
You're going to keep it for 7 years max before you refinance again or before you move, which
Oh,
means
yeah.
you reset the schedule again and you reset the schedule and you go back to giving the most amount of money. It's like it's really smart
Yeah.
for the banks. It's
They're
really good
genius.
because I'm telling you, they've convinced people to be proud giving them a lot of their money that they don't
Mhm.
have to because of the rate that's on the paper. And that's
Yeah.
one thing that we help people understand and that we help to overcome by using the first lien HELOC, using that velocity banking strategy with the first lien HELOC.
Well, I'm telling you, people, this is something to check into. If you have a current mortgage, if you are looking to purchase a home, if you have rental properties, the idea is to get you into a product that is going to help you pay off that property so that you're not sitting there just spending in interest. I don't want to see people do that. I don't want to do that. And I certainly don't want you to do that, especially if you have never even heard that there was such a product available. And, I honestly, Anthony, until I met you probably 3 years ago now, I had no idea. I had never heard of the first lien HELOC. I have people come to me every day and they say, I didn't
That's so
even know
cool.
this was out there.
Yeah.
So the idea is to get the people educated. If you don't know that this is an option, then you don't know, and
Right.
it's not your fault. But yes, we have been taken advantage of with this mortgage product that they offer because that's all I knew about. And, that's the one that makes the bank the most money. But
Yeah.
I would like to see people at least, think about, wait a minute, is there another option here?
Yeah.
And one thing I've noticed too is the difference between the origination fees of a mortgage and
Mhm.
a first lien HELOC. That seems to be astronomical as well.
Yeah.
What does this origination fee run when it comes to the first lien HELOC?
Yeah. So keep in mind that this is not just an extension of credit on top of your mortgage,
Hmm.
like a second, right? We got to remember that, right? Because this pays off your mortgage. It is a full refinance. So it's
Right.
important to remember that because of that, the transaction is a full refinance transaction, not just, hey, I call my bank and I just tell them how much money I make and they believe me. And
Hmm.
they do a soft credit pull and they do an automated, appraisal. And then 5 days later, I get my second lien HELOC. This is a refinance, just like when you bought your house or when you do any other refi, you get a full application in, there's full underwriting, credit pull, full appraisal, that kind of stuff. So it's important to remember that. But from an origination standpoint, a lot of times when you do a regular refinance for an amortized mortgage, um, there are four categories for closing costs. You've got the bank, you've got the appraisal, you've got the title, and then you got the state. The one that's going to change on you from transaction to transaction is going to be the bank fee. Your appraisal is $500 or $600. Title and state fees are pretty standardized because they're not dependent on the bank, they're dependent on the house. And so whether you're doing a first lien HELOC refinance transaction, we'll call it, or whether you're doing a conventional or FHA, your appraisal, title, and state fees are going to pretty much be the same. So then you've got the bank fee. When you're doing a regular refinance with a traditional mortgage, a lot of times your bank fees will be 1% or more of the loan amount. So if it's a $300,000 loan, that's $3,000. But then they'll also tack on what, the industry calls junk fees. So they'll throw on they'll throw on a processing fee or an underwriting fee, or, and so it ends up adding to that 1%. Sometimes it's 2%. Our fee, our bank fee is a flat $14.95 for roughly $1,500. So I can hard quote that because it doesn't change. So right now it can be substantially less, if that makes sense, than a regular refinance as well. We still do have the appraisal, title, and state fees too. So all in all, that ends up, I want to say our average nationwide ends up being around $3,800, $4,000 on average. The only thing you pay for out of pocket is the appraisal. And so everything else gets looped into your loans balance, so you don't have to come to the table with any cash.
Well, that's so much cheaper than $20,000.
It is. Yeah, absolutely.
Wow. It's just, I just run the numbers with so many clients, and it's just the game changer for most people, especially if you have the mortgage and then you have the car loan and you have the personal loan and you have the credit cards. When
Mhm.
you can bundle that, essentially gaining the cash flow that is going to take just to pay off the new line of credit that you have.
Mhm.
That's
Mhm.
amazing.
It is.
People are paying out $3,000-4,000 a month in those additional debts, the car loans and the student loans and all that. But when you calculate that into your line of credit and you gain that extra that you were paying out in payments anyway, and your mortgage payment is gone as well, you're
Mhm.
talking about that's why, you just see this crazy uh payoff period of,
Yep.
7 to 9 years, is
Yep.
because if you're not paying 20 years in interest on the mortgage alone, plus you've been able to wrap some other debt in there and gain those payments as cash flow too, it's unbelievable. I've
It's
seen it
amazing.
do absolutely amazing things. So I just want to thank you for coming out here today and having this short conversation with us to give people
Absolutely.
an idea of what that first lien is and the differences between the mortgages. I
Yep.
just feel like that when people get the information and they realize that there's even a product out here, they're going to be amazed at what it does to them in their own finances. And
Absolutely.
I'm tickled to death to offer it. Like he said, his links are going to be in the video description below. Check it out. Again, you do need around a 700 credit score. So he said over 680. So by checking what your credit score looks like, if you've got the money to make your mortgage payment now and a little bit more cash flow, you may be able to qualify for this. So reach out to them. Let them look at what's going on with your numbers and see if it's not a game changer for you. I'm just excited about it. And I tell you what, to be able to have the equity that sits in your home in a line of credit, that just seems so valuable to me because I've done investing and other things with the line of credit that
Mhm.
I know I wouldn't have been able to have done before if I hadn't had opened up the equity in my home to be able to use it in a line of credit.
Yep.
People get educated. That's what this channel is for, is to get you some information so that you can make some educated decisions. And I am just tickled to death to do it. So thank you again, Anthony.
Thank you, Christy.
I'll see you guys in the next video. Okay.
Good. That was great.
Yeah.